Motilal Oswal AMC is all set to launch a new passive fund or a set of funds at a time when markets are, well, on the edge, for lack of a better word. One needs to be ever vigilant as to what's happening to their investments by and large, but a retail investor need not have the know-how to access all of the information needed to take a proper call. That's where a fund house comes in. We have with us the MD and CEO of Motilal Oswal AMC, Aashish Somaiyaa, and head of their passive fund business, Pratik Oswal, to tell us why they see merit in passive funds at the current point of time. Gentlemen, both of you, thanks for joining in. And when I heard of this, my first thought was that here's a house which is a proponent of active investing, think equity, think Motilal Oswal, and you guys are launching passive funds. Why?
So, actually, yes, we identify ourselves as a specialist equity house. And for those viewers who may not know, this is actually our second attempt. Way back in 2010, we were actually the first fund house to launch India's first smart beta fund. And then we were the first fund house to launch the first mid-cap ETF ever. And also the first fund house to launch the first international ETF ever, which is NASDAQ. So, we have made attempts in the past. And I think the other reason, why are we actually talking about passives at this point in time?
Most importantly.
Yeah, because, look, you understand equities, probably we can claim we understand a bit of equities. And hence we are, all conversations of passive versus active, they start and end with the discussion on alpha. And, then there will be people presenting different data to say, okay, look, this fund over this time frame has alpha, I think all these discussions on limiting passive discussion to alpha is a huge disservice to the concept itself. And I'll tell you the reason why. The reality is that we have today, a couple of crore investors who have entered the equity market. And maybe 10% of those understand what is alpha and what is not alpha. But by and large, most of the people are trying to get some semblance of an asset allocation and beat fixed income as a alternative. And irrespective of whether there is alpha or not, those people are more interested to meet certain investment objectives. That's the first point. The second point is that if you are a first-time investor who's coming in, today, the world is moving towards digital DIY. And let's say you are a 25-year-old, you're going to start investing in equity. You hit upon this interesting app where you're starting, just about making a start. You listen to Bloomberg, you get some information and insights. You're just about making a start. Okay, which fund should you buy? So look, right at the onset, when people have to start investing, maybe to buy a couple of hundred good stocks, we have some 500 mutual funds. So where does one start? Digital and DIY needs simplicity. Right?
Sure.
Regulations are evolving. The regulator is talking about advisory, financial planning, asset allocation, fee-based advisory. So I think alpha will be there. Different fund managers have different strategies. Different strategies work in different market landscapes. But I think the whole discussion on passives doesn't need to be limited to presence or absence of alpha. There are digital trends, there are regulatory trends. There is a point in time in a market where certain investors need simple products. So we're just trying to give the range.
Okay. Well, either of you, and this question, the point being, one is giving the range. Two is whether this giving the range is an acceptance of a point that maybe passive investing could actually outperform actively managed funds over a period of time, because I think there was a report which spoke something to this effect of about how 50% of active funds in the large cap category at least underperform their benchmark over long periods of time. So is it also an acceptance, because you use that acceptance that maybe in certain categories passive funds could actually do better than actively managed funds?
It's to outperform FD. So in that case, I think if you can do it at a low cost, it makes a lot of sense for him, And secondly, just to use an analogy, someone who wants, say, a glass of water, he can either go to a Nudip restaurant or he can go to a Taj Mahal hotel. Obviously, the hotel in Taj might be a little more sophisticated, water might be slightly better, but ultimately, investors just want to do better than the FD, and obviously it's good for long-term investing too.
Yeah.
And coming back to the active versus passive discussion, honestly, if I tell people that, active is better than passive or passive is better than active, that's just, in my opinion, that's misselling, because, honestly, even the US, it's been happening, that discussion's been happening for 20 years, and it still happens today.
No, okay, let me rephrase my question, and either of you can take it again.
Yeah.
The idea is not to try and do an active versus passive necessarily, but the whole conversation, at least until last year, was that India is still different from the US because individual fund managers can generate alpha.
Yeah.
A lot of things are not known to the street. Small caps, mid caps can give that. With a slew of such products coming out, is the Indian fund manager or the Indian fund management industry waking up to the possibility that maybe passive funds could actually do better, because a lot of these companies and their performances are not necessarily being deciphered very correctly by the active manager, and therefore passive funds with low cost might actually do better.
So there are regulatory trends also, like, on your question, I think somewhere you mentioned large cap, for example.
Yes.
Now the reality is that yes, we are probably the first country where it is actually dictated that in a large cap fund 80% of your portfolio has to be within stock number 1 to 100 by market cap. So there are certain segments, and maybe like you rightly pointed out, I do agree that in the large cap segment there is going to be stress as fund sizes scale. So look, either you're going to focus on alpha or you're going to focus on the capacity of the fund. I don't think there will be a challenge when you say that, okay, I'll manage a pure large cap fund, it will be 20,000 crores and I will beat the index by 5% or 4% or something. So with constraints from the regulation and with size of alpha and capacity, I mean, there is a trade-off somewhere, right? So that is clearly, I think that is one trend on the large cap side for sure. But at the same time, I'll also like to place in perspective what you mentioned about the last 1 year. Look, last 1 year has been a peculiar scenario, and I'm not giving the index as a excuse for the underperformance of the industry. I think if you see, after the market bottomed out in October 2018, from there on, the outperformance has actually come back quite significantly across the board. And I think last year was more a question of polarization. Look, if you are chasing growth, you end up owning mid caps, right? You may not have all the components of the index, which, like 2014 to 2018 market was in a certain phase, and 2018 there was like a classic rotation, and then people were found chasing, right? So some people who were found chasing also don't outperform, and people who are index agnostic also, they will not outperform for some point in time. So I think last year was more situational. I think that underperformance by and large is getting corrected. But yes, I do agree on your question. I do agree that large cap space, there are constraints for sure. Okay.
So what is it that the products from your stable, the passive product from your stable, tell us about it. What is it that gets launched or has gotten launched? And what kind of investors should apply to these?
Right, so we're launching 4 index funds today. So the NFO period for that is 19th to the 30th of August, and these are very simple broad market indices. So we're looking at one mid-cap 150, which spans the entire mid-cap index from stock number 101 to 150. We have a small cap index, which spans from stock number 250 to 500. We have a bank index. So if someone's looking to make a sectoral call on the banking industry, he can do that through that. And we also have an all market index, which I'm actually most excited about. That's the Nifty 500. So you're basically buying India's top 500 stocks in that fund.
Okay. And so again, would you believe that the nature of subscribers who are subscribing to these funds should, so for example, if I want to buy not necessarily a small cap fund, which might house companies not just from 250 to 500, but maybe beyond as well, and correct me if I'm wrong here, but if I want to buy a relatively safe small cap exposure fund, that all market index, which is the Nifty 500, might be a good product because it gives me the exposure to Nifty 500 companies and at a lower cost. Is that a correct way to think about it?
Yeah, please.
Well, I think the way the index is structured in India, so that India is very top heavy. So even if you're buying the Nifty 500 today, 96% of that Nifty 500 is just large and mid cap.
Okay.
So small cap exposure is very small, which is why it's actually great. But over time, so I'll give an example. Like in the US, you have Vanguard, which is now the S&P 500 is an all large cap fund. So what it allows you to do is just participate in India's growth, broad market growth. So not now, but in say 5 or 10 years time, you can expect a lot of these companies in the small cap space becoming much bigger, and you can play that entire growth strategy.
In fact, I'll just add to that. Let's say you're a first-time investor who comes in today, you don't know what to buy. So what am I trying to do? I'm trying to enable you to buy the whole equity asset class. Put 500 rupees, buy the market, right? Now, if you're someone, nowadays, but some of my research actually tells me that nowadays youngsters, because of private equity investing, because of venture capital and so many things, youngsters are very attuned to buying small companies. And, I think that when you say the small cap index, obviously the risk is higher, right? But the fact is that in India, there are no pure small cap funds, right? I mean, the small cap funds have 65% small cap, and the rest could be cash and large cap and blah, blah, and whatever it is. And the point about the index, always what I would urge our viewers to keep in mind is that you're always buying the asset class, in totality. You're not buying a stock or underperformance or outperformance. So we are giving you slices of the market. Stock number 101 to 250 is mid cap, 251 to 500 is small cap.
Sure.
The whole 500 is the whole market, because the top 500 stocks account for 95% of the total market cap. So you bought the Indian market if you bought Nifty 500 and the minimum is $500.
Okay, how would you differentiate between, say, a Nifty ETF versus a large cap offering from your stable? This passive fund offering from your stable.
ETFs, I mean, in one way to look at it, an index fund and a ETF both are passives because they're supposed to mimic the index. But that's where the similarity starts and ends. There's nothing further. The challenge with ETFs, if you ask me, and we have ourselves made attempts with ETFs in the past, a couple of things we observed. One is that if you're going after institutional investors who want live pricing and who might be maybe hedging, or who might be trading actively, or who are very finicky about the price at which they get in, for them ETFs are good. But other than that, for by and large people who are retail investors looking at asset allocation, the better way to replicate is the index, because in an ETF, you need to deal with your broking account and demat, and then there needs to be liquidity, and you're doing a shadow boxing match with a market maker. So what happens is people claim that ETFs are cheaper. Yes, on the TER expense ratio, they may be cheaper, but when you add the brokerage and when you add the impact cost and the buy-sell spread, then I don't know if it really ends up being cheaper or not.
It doesn't?
It doesn't. According to me, it doesn't. Practically, it doesn't. On paper, maybe yes.
Okay.
The other is that when guys like us are making a genuine retail attempt, to carry an asset class to retail investors, then what better can you do other than to say, take 500 rupees, you fill a form, cut a check, buy it online, buy it on any app, buy it anywhere.
Okay.
You don't need a broking account, you don't need a demat account, you don't need to shadow box with a market maker. Easy.
Okay. Pratik, my final question on this conversation, and that is, because you had that piece, what if somebody were to come and ask you that I'm already an investor in the Motilal Oswal multi-cap fund, you can come in as well, by the way, Aashish, on this, or the mid-cap 30 fund, why is it that I should take exposure to the passively managed fund? Is that better over the other? How would you respond to that query? Because I'm sure people will come up and ask you guys as to what's happening here.
Yeah, so I mean, what I would say is that they're both very different from each other. So just give an example, Nespresso is a coffee brand and Nescafe is a coffee brand, and they're both owned by the same companies. BlackRock has one of the biggest active businesses. It also has the biggest passive businesses. So I think it's not about what is better or worse, but how it's different. So my objective is to sort of bring about and be a bit more customer-centric approach, where there are customers who are asking for this stuff. There are customers who want something a lot simpler, and there are customers who just wanted to mimic the benchmark and get equity returns. Apart from that, honestly, if you're looking at it from a very long-term perspective, say 20, 30 years time period, it's very hard for you to find a typical fund manager, because that time frame is very large. So most of India is very young. You're investing to retirement. So if you could allocate some of your assets to passive with goals that are very long-term oriented, then it makes a lot more sense to invest in an index fund. Yeah.
Okay. See, how I would put it is that you break the equity offerings. All the equity offerings, you break it into a pyramid which has, you assume, 4 strata.
Yeah.
The most basic one is to buy the market or the beta. Then there are certain strategies which are actually what I would call beta plus, because their portfolio allocations are within a very narrow tracking range compared to the index. Then there are guys like us who say QGLP, meaning that we are playing in a very narrow universe and our portfolio allocations are agnostic to index. So we are seeking alpha. When we have alpha, it is like a huge number, and when we underperform also, we have to take it in our stride, because it is a risky strategy in that sense. So there is beta, there is a bit of beta plus, and then there is the real alpha seeking, and the top strata is the alternates. So now if you look at Motilal Oswal AMC, we've always been in alternates through our PMS and AIFs. We've always been an alpha seeking house because we have an index agnostic strategy. We are not in the second strata, which is index plus a tracking range. And we are in the lowest strata, which is passives.
Okay.
So it's about beliefs, and it's about what you're offering to different customer segments. I think that's how I would put it, actually.
Okay, gentlemen, all the best with the offerings. Thanks so much for taking the time out and speaking to us at Bloomberg Quint out here.
Thank you.
And viewers, thanks for tuning in to this broadcast.